Our supply manager survey for December, the results from that survey provided a leading economic indicator that's slightly above growth neutral. So I expect the economy to grow, but unfortunately this growth is going to be at a snail's pace. In other words, we're not seeing any significant job growth. We're likely to see jobs added for the first quarter of 2010. But again, those jobs are not going to be in manufacturing. They're going to be in, of course, government. They're going to be outside of manufacturing. There are going to be some trucking jobs added from many of the states in the region. The 9 states that we survey each month, been surveying these states since 1994. So this rebound out of this recession that we're currently seeing is a good deal weaker than the rebound we saw coming out of the 2001 recession. So all in all, it's just not what we'd like to see. There's just too much uncertainty from consumers, too much uncertainty from businesses, and even government. Some of the uncertainty there, local government, state government, where they're going to find the funds to support spending in the next year, 2 years.
You said that this recovery appears to be subdued.
That would be a kind word. Subdued is it's weak. It's tepid. In other words, the index ranges from 0 to 100. 50 is growth neutral, and it's just ever so slightly above growth neutral. So it was a weak report. Unfortunately, the stronger parts of the report were in the inflation area. The Federal Reserve has been on a rate-cutting binge now. Of course, rates are at the lowest level since 1913 when the Federal Reserve was formed. Those 0 to 1/4% interest rates, that's really stimulating inflationary pressures. We're seeing some bubbles. So for the consumer out there, for the investor out there, and the businesses out there, is where's the next bubble? There are bubbles right now. We're seeing gold prices, of course, up significantly. Oil prices have now begun to rebound even stronger. Natural gas prices showing a little bit better growth. And of course, a lot of that is due to the Federal Reserve's interest rate policy. So again, we're seeing some bubbles, and we're going to see some bubbles. The question is for the investor is how do you take advantage of that? One thing I'd recommend certainly is watch out for U.S. Treasuries. As interest rates rise, and that we're going to likely see that with inflation going up, that pushes down the prices of U.S. Treasury bonds, so you can lose a heck of a lot of money very quickly, in my judgment, in Treasuries, for example.
One of the things you mentioned also was that inventories remain low.
It's most baffling to some degree. I'm an economist, not a supply manager, and these individuals we're surveying, they buy inventories, raw materials and supplies. They've been cutting their inventory levels for 15 straight months now, and that's of course contributing to the slower growth. They've been cutting anything they can cut, inventory levels, their number of employees, cutting hours in some cases. All this is slowing the economy down, and it's delaying the rebound. Interestingly, this month we asked the supply managers to look at their inventory levels, that's both finished goods and inputs, and compare that to what's optimum. About 80% think that about right. So they're not. There's no pressure there to any large degree to increase inventory levels. So the fact is that a lot of economists, including myself, we've been thinking we're going to get a rebound in inventories. According to the supply managers, that's not the case. In other words, these rebounds, these inventory levels, are with us for into the future.
What about the decade? You took a look at that and sort of the job losses, but how that was made up.
It's, in the states that we survey, the really big winners, relatively speaking, percentage-wise, North Dakota, South Dakota, Nebraska, Iowa, Missouri less so, Minnesota less so, Kansas less so, Arkansas, pretty good growth there. So the 3 states that saw less growth, and the decade ended the decade down, in other words, fewer jobs at the end of the decade than at the beginning of the decade, were Minnesota, Missouri, and Kansas. And of course, those are the three of the larger states, Minnesota and Missouri. And of course, a lot of it had to do with manufacturing. Any state that has a high level of manufacturing share-wise saw a bad decade from the job standpoint. That doesn't mean the economy did not very well. What was happening, of course, was productivity growth. Productivity growth was cutting into the jobs, and that's what we saw in most of the states in manufacturing.
What else?
Well, we're going to see, unfortunately, for 2010, looking out in my crystal ball. Of course, my crystal ball is these 900 businesses that we survey each month. So I'm looking at what they're telling us and what they're telling Creighton University in our survey, and what they're saying is a lot of uncertainty out there. We're likely to see higher interest rates for 2010, higher inflation for 2010, and higher taxes for 2010. And all that with the backdrop of cap and trade, healthcare reform, credit card reform, which is going into place on February the 22nd. All that is really putting a pinch on the economy right now, and that's showing up in our survey. Now, in this case, a pinch means that the economy is growing, albeit at a very slow pace. We'll know more about that when the jobs report comes out Friday, telling us how many jobs the U.S. economy added. It won't be many. It might be positive. It might be the first positive report we've had for many, many months, since November of 2007. So that would be quite good. But again, it's not going to be that strong.